Hi, everyone, and welcome to Behind the Numbers. I'm Dave Bookbinder, Senior Director at CFGI, where I help my clients with their most important accounting and finance needs. Feel free to reach out to me if you'd like to connect. I'm on LinkedIn, Facebook, and Twitter. This is the show, as you know, where we dig deeper to understand what matters most in business. And today we're going to be going behind the numbers on a personal investment theme. And I'm pleased to welcome a dear friend, Scott Inglis, who's a Regional Director at Carnegie Investment Counsel. Scott, welcome to Behind the Numbers. Pleasure to have you here.
Dave, thank you for having me. Glad to be here.
Well, in full disclosure and full transparency, I'm a client of Scott and Carnegie, so just want to set the frame right there. We're not going to be talking about investment advice today. We're going to be talking about understanding themes and patterns and really demystifying some of the noise maybe that you've experienced out in the marketplace. So with that as a backdrop, Scott, why don't you just tell the folks watching and listening a little bit about who you are and a little bit about Carnegie, and then we'll jump in.
Sure. Well, Dave, Carnegie Investment Counsel is a registered investment advisory firm. We have 8 offices across the country, and we serve families, foundations, and corporations in their investment management and wealth management. I work out of the Philadelphia office, and I am, as you said, a portfolio manager and regional director, working with clients, helping them to grow, maintain, and preserve their wealth.
Sounds good. Why don't we start with trying to help folks kind of level the playing field on what an investment advisor is. You know, you watch television and you see commercials of all kinds, you know, the major brokerage houses, the people who say that they're, investment representatives. There's a lot of different titles and letters. It's alphabet soup out there. Help us to understand the investment advisor playing field.
That is one of the things I get asked quite often, and one of the things I feel like the investing public is in need of better guidance on. And we at Carnegie, we've produced something called a guide to choosing an investment advisor, which I would suggest that people take a look at our website for. But there are different, a registered investment advisory firm like Carnegie, we're held to a fiduciary standard, which means that as we're regulated by the SEC, and we're required to put clients' interests and best interests ahead of ours or the firm's. We don't sell financial products. We just provide advice and guidance, and so we don't sell insurance products. We don't sell, and so there are different types of investment firms that do sell financial products. And so I think it's very important for people to know, if they're working for an advisor, how they're compensated. We get our fees only, we're fee only, and we get our fees only from what our clients pay us for advice and for our service. We don't get compensation for selling any kind of financial products. So that's a starting point, is for, you know, if you're going to work with a financial advisor, first and up front, understand, are they selling financial products? Or are they going to be working with you as a financial partner, providing advice and guidance for a fee, but with no kickbacks or any secondary gain from the relationship?
Yeah, you want somebody sitting on your side of the table. I mean, you don't want to be looking at your statement and wonder, why did they make that transaction? Why did they do the buy-sell? And are they just looking to make a commission? Totally got it. A lot of confusing noise out there.
There is.
Let's talk about another topic that's a favorite of mine in terms of putting together a portfolio. Diversification. So in the early stages of people's careers, maybe they don't have enough money to, if they're thinking about individual stocks, to build a diversified portfolio. And as people get further along in their investing careers, then they've got more latitude. But how should people be thinking about diversification? Is that truly the only free lunch in investing?
Is diversification the only free lunch? Well, what I'll say is diversification preserves wealth, and concentration builds wealth. So it depends on what you're seeking to do and how you look at diversification. So in a sense, you can be overly diversified. I've seen portfolios, I've looked at portfolios that have had 30, 40 different mutual funds in them. And those funds all have fees, and on top of that, they're paying an advisory fee. And so that type of diversification I call de-worsification, because you end up with a glorified index fund, but you're paying potentially 2% for what you could get at Vanguard for, a fraction of a percent.
Right.
Is diversification a free lunch? I've seen where diversification leads to diversification, and it's far from a free lunch. It's one of the most expensive, free lunches you'll ever get. At Carnegie, what we do is, with clients that have enough resource, we essentially build a portfolio with individual securities and take all those layers of costs out. And so you can be appropriately diversified with individual securities and achieve diversification in a very low-cost, transparent way.
Yeah, when you talk about owning 30 different mutual funds, at some point you're owning the same stocks over and over again, just in different baskets, like you said, with different fees attached to them.
Exactly.
Yeah, can we talk about cost a little bit?
Sure.
So the mutual fund side has fees associated with it. And maybe somewhere in this we're going to dovetail into the concept of the indexing versus active management, because index funds have lower costs. So why don't we actually start there? Why don't we talk about the benefits or the pitfalls of indexing? It's a very simplified way to do it. I'm a fan of it, and we've had many conversations
Sure.
about the benefits and the downsides.
Yeah, yes, we have. We've had some good, healthy debates about it. Indexing and capitalization-weighted indexing, which is where so the S&P 500 index, for example, weights companies by their size, their size in the market, and it is an effective way to get broad exposure to the overall market. However, there are times when the market becomes overly concentrated, and perhaps we're in one of those times now. It doesn't happen often, so most of the time being diversified and owning the market can be a very good and effective strategy. There are times, though, when the market becomes so concentrated amongst the biggest companies that you're not getting as much exposure to the smaller, faster growing, more nimble, up-and-coming competitors. They kind of get drowned out by the larger companies in the index.
Yeah, they certainly don't make it into the S&P 500, for example.
Right.
Too small.
Right. So indexing it absolutely has its place, and it is an effective. I think Warren Buffett's saying on it is that for a know-nothing investor, indexing is the way to go. Because you set it and forget it, you own the market. And but if you're working with an advisor, who knows something, then you can achieve the diversification benefits of the index. But at Carnegie, we build custom portfolios that are more tailored to the client's needs using individual securities. We can achieve the same level of diversification, but with more purpose, better tax management, better asset location. What I would say is that indexing and indexes are a blunt instrument. Mm-hmm. And so sometimes a blunt instrument is okay, but when you want to be more tactical and precise and use more precision, you want tools that allow you that. And individual securities and moving away from index funds makes sense in that case, if that makes sense.
Yeah, and I know you've got some numbers that can speak to the idea of the value add of a good advisor vis-a-vis an index fund. Why don't you speak to that a little bit?
Sure. And these aren't numbers from Carnegie or mine, but numbers that Vanguard and Morningstar have published. They've done studies to try and quantify, and your theme is behind the numbers. So first we'll quantify, and then we'll talk about what's behind the numbers. Vanguard suggests that working with an advisor can add up to 3% per annum in value to a client relationship and to the value of their portfolio over time. Morningstar suggests that value is in the neighborhood of 1.5 to 1.6%. In both cases, the single biggest driver of added value, they believe, is the objective advice and behavioral coaching that comes from working with somebody independent and a third party. So, take a couple or even an individual. We with our own money, we tend to be very emotional. We work hard every day to earn a living and to accumulate and save, and emotions and financial decisions inherently become intertwined in our personal lives. And the biggest value add, according to those studies and according to my experience, is the emotional objectivity that an advisor brings to the relationship. An advisor can help make objective, unemotional, or at least present the facts in a way that allows for clients to see the decisions in front of them, whether it's, hey, I want to get out of the market in April of 2020 in the middle of a pandemic, to, hey, we really want to buy, a second home or a boat, and an advisor can help to objectify those decisions, can help to quantify the implications of the decisions, and bring that third-party emotional objectivity, and that's the behavioral coaching piece. That's the biggest value add from partnering with a financial advisor, above and beyond the investment management.
Yeah, because as they say, you've got to be smart twice, right? You got to know when to get in, when to get out, and
right.
That emotional tie that you have to your decisions, that's tough, and I couldn't agree with you more that taking the emotions out and adding the discipline is a huge value add. And that's probably a really good segue for folks watching and listening if they want to know how to connect with you. Scott, what's the best way for them to reach you?
Well, sure. Our website is carnegieinvest.com, all one word. And my contact information is SINGLIS@carnegieinvest.com. If people would like to email me or just check out Carnegie's website, there is some educational material, like I said, about how to choose a financial advisor, which I don't envy people. There is, as you said, a tremendous amount of noise out there.
Yeah.
And I think that is a real essential value add that we can bring, is to educate people on the best way to find a fit for them.
Yeah, sure. So when we talk about a lot of noise out there, a lot of current topics, thematic themes, and they can come in a number of different flavors. One such flavor is ESG investing. We have about 5 minutes to go in this segment, so we don't have a whole lot of time to go down a rabbit hole here, but can you touch on some of these thematic themes and how people can think about them in context? From my lens, it feels like they may be more of that little seasoning on the steak as opposed to your meat and potatoes, if you will. Man, that's a botched metaphor, but I think you know what I'm trying to say. In small doses.
Yeah, right. Well, you're right. There's always a ton of things coming at the investing public. Right now, ESG is front and center. We hear things like SPACs, cryptocurrencies. These are all things that are in the air that are in popular finance.
Yes, and I want to get into those after the break.
Yeah,
so don't go there now.
No, but what I would say is, you asked, Carnegie is one of the things that I love about Carnegie is the scale and scope of our experience of the portfolio managers. So we have someone who's actually spent significant hours learning about ESG and investigating that as a as a topic. And so we're well informed when it comes to ESG. In fact, we have the ability to build a custom ESG or socially. People might not know what ESG is, but
environmental, social governance. Good point.
Environmental, social, and governance.
Yes.
That's another thing that people are bombarded by in this industry, is these acronyms. It's alphabet soup for the investing public, but it's investments that are environmentally, socially, and have good governance as a part of their makeup. And there are ranking services. There are various ranking services. Morgan Stanley Capital International, MSCI, another acronym, is one of the purveyors. There are others that have different standards and rankings for ranking companies on those measures. And so, working with a firm like Carnegie, we can build, whether it's with exchange-traded funds that have environmental, social, and governance as rankings as a part of their metrics, or our own custom portfolios where we rank our holdings by their ESG criteria. We can meet investors where they are and build a socially conscious, environmentally friendly portfolio. An obvious example might be in the energy space
Sure.
Where you've got clean energy companies that are investing in solar and wind. You've got the traditional so-called dirty energy companies that are still investing in oil and gas, and so forth. So the ability to customize is one of the things that we really love about what we do at Carnegie, and especially when these things like ESG come along, we can tailor the portfolio exactly to where that client is at on that particular issue.
Gotcha, good stuff. And that's a good spot to take a quick break. Scott, you sit tight. We're talking with Scott Inglis, who's a regional director at Carnegie Investment Counsel. I'm Dave Bookbinder, and we're going to be right back on Behind the Numbers after this quick commercial break. Don't go anywhere.
Boardwalks built for fun. Legendary rock and roll clubs.
This is how we do it. Hip hop.
Casinos by the ocean.
Hip hop.
Now that's New Jersey. 130 miles of beautiful beaches. Solid rock. And everything in between.
Look in the window.
Now that's New Jersey.
Hey, welcome back to Behind the Numbers. I'm Dave Bookbinder, and we're talking with Scott Inglis from Carnegie Investment Counsel. Scott, a lot to cover yet here in the second half of the program, and I want to start on a topic of cryptocurrency from the standpoint that that's another one of those things that's in the news every day.
Sure.
And we're not looking for investment advice or how people can even think about or invest in it, but maybe you can just help explain what that is for those who are maybe less informed and have heard about Elon Musk's on Saturday Night Live. What's that going to do to crypto?
Right.
What is cryptocurrency? How do people think about it to understand it?
Sure. Well, one way to think of it is just digital currency. So we have currencies. Everybody knows what dollars are. And digital currencies are a different form. So, and some people talk about cryptocurrency as an asset class, like it's something new and different. I think it's a form of something that we're very familiar with. Mm-hmm. So let's talk about currency and what the purpose of currency is for. There are a few different things that are necessary for something to be a useful currency. It needs to be something that we can measure the value of other things with.
Sure.
We can use it to transact
Right.
and exchange value. We can use it as a record of account, as a way of accounting for a business, say, right? Mm-hmm. We use currency to account for the value of a business. And a store of value is another form of currency. So if we think of alternatives to the dollar, alternative currencies throughout history, the one that most people turn to is they think about gold.
Yeah.
Gold, because of its nature, it's often been seen as the best store of value alternative to traditional currencies. So there are elements of digital currencies, and there are many, and of course the more popular ones you alluded to already. But whether it's Ethereum or Litecoin or Bitcoin, we certainly don't take a view or have a recommendation about any of those. However, we can look at those and ask, do they measure up to what a traditional currency does? And there are aspects of the new digital currencies that do allow us to exchange value, that do allow us to transact. Popular platforms like Square and PayPal are allowing people to transact now in digital currencies. And so they absolutely have a role. I hear people talk about them as an alternative asset class. And I'm not sure about that because, well, they're cryptocurrencies, so currency's in the word. And we already have an asset class called currency. And so digital currencies, I would think of, probably have some of the characteristics of traditional currencies and belong in that asset class. Then we have gold, which we mentioned before, which is a commodity, a precious metal, which commodities are an asset class. And so if in fact some of these digital currencies are like digital gold, you hear some people refer to some of them, then in fact they have the properties of a commodity. So, you know, while the names and they've been a source of a lot of popular discussion and even speculation,
yeah.
I think there's a lot of underpinnings to cryptocurrencies that are very similar to things that we're already very familiar with. They're just new in different forms. And the last thing I'll say is that the real power, I would say an analogy of the way to think of cryptocurrency is, as email was to the internet, so email being AOL mail, Gmail, etc. As email is to the internet, cryptocurrencies are to blockchain technology. So blockchain technology is the technology, the underpinnings that sit underneath. It's the technology that sits underneath the cryptocurrencies. Cryptocurrencies are just one application of blockchain technology. So blockchain technology is a bit like triple entry bookkeeping. Double entry bookkeeping was invented about 400 or 500 years ago. It's what we use to measure debits and credits, balance our checkbook,
right.
Manage a business. The thing that blockchain adds is a layer of security that's above and beyond what's there in the analog double entry bookkeeping world. And so that's transforming how Walmart, for example, tracks inventory. And they can, instead of it taking a week to track down the source of a perishable on their shelves that has an issue, now they can do it in minutes using blockchain technology. So that's the real power that's sitting underneath there. And a lot of the popularity around cryptocurrency is taking the eye off the ball of where the real power lies, and that's in blockchain.
Gotcha. Scott, how can people reach out to you if they want to learn more about you, pick your brain, work with you, have coffee with you?
Well, as I mentioned before, SINGLIS@carnegieinvest.com is the best way to email me. My information is available on our carnegieinvest.com website, and I'd be more than happy to have a conversation with any of your viewers.
Sounds good. Scott, we only have about 3 minutes to go here, and I know we could go for another hour easily, but I wanted to just touch on something very quickly. Retirement, everybody's looking to plan for retirement. In 3 minutes that we have, how can people think about retirement planning? How do they know if they're on track?
Perfect segue, Dave. And I think the behind the numbers theme, everybody wants to know what is their number, right?
Yeah.
How much do I need to retire? And the other question is, am I going to run out of money? Those, for people in that, what I call the retirement red zone.
Yeah, we don't want to eat cat food, right, in retirement.
When you're plus or minus 5 years of retirement, that topic starts to become front of mind for a lot of people. And we work very closely with people to help understand. And the way we get at it is we look at the financial resources, we look at the portfolio assets, potential pension, other sources of income, of course, Social Security. We pull all that together into a cash flow projection that looks at how is retirement going to be funded. And there's no one answer. There is no one number, unfortunately. There is no magic number for people. But when we talked earlier about behavioral coaching, one of the things I think that clients value most with working with a Carnegie portfolio manager and advisor is the confidence that comes from being able to quantify for them what's a very complex emotional decision. Can I retire? Should I retire? When can I retire? To be able to quantify that and to provide confidence in the decision and know that they're not in it by themselves, but that they've got a partner with them. We do this. We've got hundreds and hundreds of examples of successfully leading people into and through retirement at Carnegie Investment Counsel. Most clients have one chance to get this right. And so partnering with somebody is essential we find that the confidence that comes with partnering somebody like a fiduciary financial advisor, like a Carnegie Investment Counsel portfolio manager, like Scott, is a huge weight lifted off of client shoulders, knowing that they're not in this by themselves, and that retirement decision is going to be done with confidence.
Yeah, that's so true, because just knowing that it's modeled, you've got something you can actually look to and not just think, well, geez, am I going to work till I'm 90?
Yeah.
Think about it that way. Scott, thanks so much for joining us today. Really appreciate you being
Dave,
here.
thank you. Always enjoy the conversation.
And thank you for watching and listening to Behind the Numbers. We've been talking with Scott Inglis, a portfolio manager and regional director at Carnegie Investment Counsel. Do check him out. He's a good man. I can tell you that personally. My name is Dave Bookbinder. As I said earlier, feel free to reach out to me. I'm on LinkedIn, Facebook, and Twitter. And we will see you next time on Behind the Numbers. Take care, everybody.